That's not good. We can see now that we aren't even close to being within the law limits of what the diff fund is supposed to have. Also, if you look at this from the second quarter of '08 to the first quarter of this year, uh, you can see just this downtrend, and you can even see it from this chart of how the fund, the amount in the fund keeps going down. Well, that's because of these bank failures, and as I stated earlier, the bank failures the diff fund, cost the FDIC, and you see this big jump. Well, in '09, they did a special assessment on banks, which said that a special assessment is basically a nice way of saying we're going to charge you a fee because you're so special. Uh, they charged them 3 years worth of fees so that they could get the diff fund up because as you can see, this is going down, 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 down. And they would have really been in a cash crunch had they not done this. So they did a special assessment to get more money, and even then, you can still see it's still trending down, even from there, because banks are, especially commercial banks, are closing at an accelerated rate. So this downward trend will continue. So let's go to the income statement. How much money is it bringing in or losing? You do assessments earned here, and you get 3.2 billion. Add all this up, they receive 3.4 billion. But once you look at the expenses, it's 3.4 billion, but it's a little more. Um, what, $4 million more? Yep. And so you have a net loss of $4 billion. That's your income statement. That's not good. That's not good. And you can see that even in December of '09 and even a year ago, uh, losses. It's a net loss. Now, you didn't lose as much this year, but it's still a loss. Uh, that's not good. Not good. Now, I came down here, and what this shows are the money that the FDIC got or received each quarter since 2008 to the first quarter of this year, and how much it's paying out. And I said, this will be an interesting experiment. So what I did was I wanted to see the how bad this really was. Uh, and so I took this number, all these numbers, and added them up on cash received. Uh, and this is cash received from receiverships. So the money that the like we saw earlier that um, First Midwest was paying a 1% premium um, to take over the deposits. Well, this is the money that they get, part of the money that they get from that. And when I added this up, it came out to $11 billion, 11 billion with the B. But when I added up the payments for what they had to pay out because of these receiverships, that came out to 76.5 billion. Now, I'm not a genius, but when you run the numbers, not quite hard, essentially, for every dollar that they're paying, that they're receiving uh, from the receivership, they're paying out seven. So they're paying out seven times more than they're actually bringing in. I may be, I'm not that good at, I may not be an Einstein, but um, that's a recipe for disaster. When you're paying seven times more than you're actually making, that's not good. And you can actually see that in this chart here, where the green is what they're taking in, and the yellow, which far outsees the green, is what they're actually paying out. Not good, not good at all. Let's go to the cash flow statement. So that net loss I showed of $4 million, that goes on your top line for cash flows. Now, the net cash that's provided by operating activities, well, it's negative. So just to operate the fund, you're operating it at $1.6 billion loss. Not good. Also, the cash that you invested in treasuries and things like that, uh, um, that's negative almost $12 billion. So when you add these two together, you end up with this number, which isn't good. And because and you take the cash you had at the beginning of the year, add it to this number, and that gives you how much cash you actually have in the fund. So this is the cash you actually have in the fund. But if you recall, when we went to the balance sheet, it said that there were 63 billion, and what that is that extra money is coming from the investments, the of which isn't cash, but you can convert those bonds, notes, whatever, easily into cash. So it's in a cash it's a cash equivalent essentially. Um, and so the question then becomes, you're losing money on all these deals at average rate of $7, 7 to 1. And number two, you're not even within the law limitations, of which even that limit is very low. Second, third, at 63 billion, how does 63 billion cover $7 trillion in deposits? The answer is it doesn't. It can't. It will never. And even if you say all 7 trillion won't be at risk, pick a number. Pick a trillion. 63 billion won't cover a trillion either. So this idea that your your money is safe, I gotta beg to differ. Because if there's a run on any of these banks, like there was potentially going to be one if they had not passed the $700 billion TARP bill back in September of '08, then that would have left a lot of major runs on the banks, and companies like Wells Fargo, Bank of America, JP Morgan Chase, Citigroup, a lot of these big banks, you would not know them anymore. They wouldn't exist because they would not have the money to cover the loan losses, nor would the FDIC have the money to cover the losses on the deposits. So this number here, they can raise this up to 1 million. It wouldn't matter. The diff fund is what matters, and as we've just seen, it's losing money. It's losing money every quarter, and this is going to be going on for the next couple of years. Next couple of years. So you can think your money's safe in there, but if everybody panics and wants to get their money out at the same time, the banks don't have the money, nor does the FDIC. It works the same as Geico. Uh, if everybody who had a claim went to them, everybody who had insurance with them filed the claim at the same time, catastrophic claim, Geico would be out of business. They wouldn't be able to do it. Well, this is the same, and I would probably say this is even worse because they only cover at max 1.5% of the deposits. So a 2% move and the diff is all gone, period. And now it's even less so because it's not even close to the 1.5% of the $7 trillion in deposits. So I hope this wasn't too confusing, but I guess the basic gist of it was you can't take things on face value. You really have to dig deep and understand how this works. The diff fund, which is the thing that's supposed to pay your insurance for your deposits. I guess my point is they don't have the money to cover everybody. So you may be just stuck out if something catastrophic like what was going to happen in September of '08 happens. You'll be stuck out. You'll be stuck out. So maybe you should take that into consideration when putting money into the bank. Not telling you not to, just telling you to take it into consideration. That's my time. I hope you have been enlightened, and that's all for today. Goodbye. God bless.